Hello everyone, this is Andrew. I'm a real estate investor from Toronto and welcome to my Real Estate Investing 101 series. The goal of this series is to educate, provide value, and inspire those that want to get into real estate investing on their own. So today I wanted to talk about dead money and what does dead money look like. It sounds scary, but it is. Generally speaking, we find that we have money invested in areas or money not invested in areas that is essentially not doing anything for us. So what can that look like? A couple of examples are, I've got a bit of a list here. No particular order, but funds that are just sitting in a bank account or perhaps in a low interest yield bank account, like a high savings bank account, which is maybe 1%, maybe 1.5% if you're lucky. Underperforming mutual funds. We have holding in cash, which would be like holding in a bank account, I guess. Unused credit lines, untapped home equity. If you've lived in a market that's appreciated a lot and you haven't looked into unlocking some of that. And say low interest bonds. So some of these are safer than others. You might want your money in a low interest bond for whatever reason. Maybe you don't have a high threshold for risk. But essentially, all of these things could be earning you more interest in, say, for example, real estate investing. So low interest, no interest accounts, like I said, a high interest savings account is only 1.5%. If you had a significant amount of money in there, you really would be missing out on quite a bit of returns there. Mutual funds, this is a bit of a pet peeve for me. Maybe I'll spend a little bit more time on this than not a lot of people realize that mutual funds are really designed for the mutual fund companies. They don't really help you all that much. Might be unpopular with some financial advisors out there, but I guess not all mutual funds are created equally, but a lot of the bank-run mutual funds can be riddled with fees that you don't see, and the return, if it says it's an average return of 6%, you have to keep in mind that your management ratio, the MER, is potentially 2 or 3%. So really, your 6% is now only 3%, or if your 10% is only, 7 or 8%. And that the returns that are advertised are averaged over time. So yeah, the stock market. A lot of people obviously have success in the stock market, and it's a 10% average, or 10 to 12% average return over time. I like my returns to be a little bit steeper than that in a short period of time. Holding cash obviously is not doing you any good, and the thing that you have to realize is that holding cash is like saving is a terrible idea. Saving with purpose towards something is a great idea, but just saving money because inflation is going up every year. So if you have your funds in cash, you're actually losing money every year, even though you're contributing to it, but its own value is diminishing every single year. Credit lines. If you had a $50,000 credit line, it may be counterintuitive to use that money on anything that you don't absolutely need at the moment. A lot of people look at their credit lines as their emergency funds. But really, if you took that credit line and put it in a safe investment, I wouldn't recommend gambling in the stock market, especially if you don't know what you're doing and you're not a professional day trader. But if you could get into something pretty secure, like, for example, private loans, which I'll discuss in a different video, but you could get an interest rate of 10% loaning to an investor backed by a property. And even though you're paying in a credit line, you might be paying, 7%, 6%, something like that. As long as you're making more interest, you're coming out ahead at the end of the day. Certainly the same goes for untapped equity in your home. In Toronto especially, in the past 5 years or so, the market has appreciated so much that you've probably got a lot of money sitting in equity in your home. If you were to convert that into a HELOC, then you could use that money at a much lower interest rate than an unsecured credit line, perhaps 4%, maybe even less nowadays. This is being recorded in COVID times, so the interest rates are through the floor. So you could take that money and deploy it. You could even buy an entire house in some markets if you had a $200,000 HELOC credit line on your house. So you could buy an investment property, and the property values. Property doesn't fluctuate very quickly. I know there's a lot of doom and gloom that the market's coming down, but as long as you don't sell it in the next year or so, even if it did come down, it wouldn't really matter. So you could be earning cash flow and appreciation. You could loan that money out to another investor. If you loaned your money at 10%, let's say, for example, and you're only paying 4% in your HELOC, that's 6% money you're making right there. It's pretty good odds. And then bonds, of course, that's very safe, but it's not earning you. It's not a progressive. So if you wanted to make more returns, I suggest not leaving your money in all of these different vessels, and really look at something like a real estate investing or private money lending towards real estate investing as an alternative. Anyway, if you've enjoyed this video, please like and subscribe to my channel if you're watching on YouTube. Otherwise, thank you for watching, everybody, and I look forward to sharing more in the future. Take care.